This podcast is sponsored by the Trader Funding Program by Forex Analytics. Do you want to trade somebody else's money but want to receive the lion's shares of the profit and take none of the risk? Pass an assessment with a one-time fee and trade your own live trading account. There's no time limit to pass. Various account sizes are available based on your needs, and each comes with the Forex Analytics platform and access to one of the most active trading communities in the markets for a period of time. Visit traderfundingprogram.com for more information.
Good day, everyone. Welcome to the MicDropMarkets podcast with Simon Mikhailovich, who is the co-founder and managing partner at the Bullion Reserve and a member of the TBR Board of Directors. Simon is an entrepreneur and a contrarian investor who predicted and profited from the financial crisis of 2000 and 2008 prior to co-founding TBR in 2013. Simon co-founded Eidesis Capital, a special situations investment firm, between 1998 and 2014. Eidesis team employed over $2.5 billion of capital through special opportunity funds focused on high-yield corporate bonds and loans, credit derivatives, and distressed CDOs and MBS, and gold. Previously, he was a portfolio manager at Falcon Asset Management, overseeing alternative investments in hard assets, including oil and gas properties, timberlands, and agribusiness. During the credit cycle of the early 1990s, he headed a workouts team responsible for restructuring multiple businesses in North America and Europe. He has received an MS in business from the University of Baltimore and a BS from Johns Hopkins University. Simon, I've been waiting to talk to you for so long on this podcast. I'm so glad that you could welcome us to, you could be with us today. I kind of wanted to start broadly, and let's talk about your view on physical gold and how do you think about it right now?
Thank you for the introduction, and very happy to be with you. And thank you for having me. So what I wanted to start with is, gold is different things, a different thing to different people. I mean, it's jewelry. It goes into high tech. Every high tech manufacturing, every iPhone or every cell phone has, a little bit of gold in it. Every computer has a little bit of gold in it. Central banks use gold for reserves, and of course, investors can speculate on gold price. In which case they usually use derivatives, but people who think of gold as a long-term, is basically capital, long-term store of value, usually use physical gold for reasons which we will touch on. So to kind of tee up this discussion, I think it's important to understand the context and the framework for thinking about what physical gold is and is not. And in that sense, I think our discussion will be more meaningful to people who are listening. So my hobby happens to be sailing, and a lot of rules and ideas that prevail in sailing are very much transferable to investing. So let me give you an example. So when I started learning how to sail, a very experienced racer and sailor taught me that there are 6 C's to sailing. I mean, there's 6 C's you need to understand and know. You have to know your captain, which if it's yourself, you have to understand yourself and your strengths and weaknesses. You have to know the crew. You have to know the craft, which is the vessel on which you are setting out. You have to understand the currents. You have to understand the conditions, which is in financial parlance would be volatility and which way the wind is blowing. And based on that, you have to set the course. So you would observe that the first 3, which is yourself, the crew, and the craft, you have some control over, and you can make sure that it's fit for the trip. And of course, you can choose the course based on the conditions and the currents, but you don't control the currents or conditions. And those can change very quickly. So it's the same in investing. You have to understand yourself. You have to understand the people who are helping you invest. You have to have the vessel that is appropriate for the type of conditions and the type of currents that you may encounter along the trip. And your course has to be reflective of your ability to achieve your objectives, given the potential changes in conditions. So in this simple framework, what is gold? I mean, gold is a lifeboat. Lifeboat is an expense. It doesn't help you win the race. It helps you get to the end of the race if conditions change in a way that may otherwise prevent you getting there. But it's usually an expense. So a lot of people think of gold, well, it doesn't produce any income, therefore it's either a trading vessel or vehicle, or it's dead money. And therefore, when interest rates, or real interest rates, I should say, go up, therefore, it's more profitable to have money in income-producing instruments, which makes sense if you don't include considerations like credit risk, where it's not about return on your capital, but return of your capital. So let me give you an example also from sailing, where lifeboats and that management comes into play. So everybody knows about Titanic. It's a cliche. Where people have a lot of memes and jokes about it. But if you take just 1 second and think, well, not think, and look at what actually happened there. The captain was very experienced. The ship was considered unsinkable. The crew had never worked together before. They were assembled at the last minute. Because the ships of this caliber were considered unsinkable, the crew did not have any training or any ability to handle deployment of lifeboats. And again, because sinking was not a possibility, or was not considered a possibility, there were enough lifeboats to accommodate about half the people aboard. And when the disaster struck, the crew didn't know what they were doing. The lifeboats were deployed, but basically 2/3 of the people died and only 1/3 survived. So it was a failure of imagination. It was a failure of preparation, and it was a failure of execution. And up until the fatal moment when the iceberg was struck, the trip was wonderful. Everything was great, and there was absolutely no sign of disaster. From the moment of the crisis, as it started, in 2 hours and 40 minutes, it was all over. So the lesson for investing here is that conditions can change without a warning. The volatility can be zero right up until the moment of disaster. And once disaster strikes, an unprepared crew can cost a lot of lives by not knowing what they're doing and not being prepared. So where are we in the investment world in this framework? We have not had a hurricane, if you will. We've had many, short, violent storms, but we have not had a hurricane since the 1930s, really. We have not been in the high interest rate or highly inflationary environment since the 70s. So basically, no manager who is working today has ever had to manage volatility, prolonged periods of volatility that cannot be fixed by the government, within weeks, days, or months. The captain of the ship has never been in this situation either. And the lifeboats, and if gold is a lifeboat, first of all, why is gold a lifeboat? I mean, how does it? What does a lifeboat needs to be in order to be an effective vessel for salvation? It obviously has to operate independently from the mothership. So gold, because it is the only tangible financial asset, and the only financial asset that does not have a counterparty, because it is a physical item, does not depend on the financial system. So it is the only financial asset that is not tethered in any way, shape, or form to financial institutions, financial markets, digital networks. There's no ledger, there's no third-party transaction validation, there's nothing. A bar of gold is not a promise, or a coin, it's not a promise to do anything. It is what it is. The next thing about gold, which stands out, it does not have risk of permanent impairment. In other words, again, because of its physicality and because of its chemical and physical properties, it is virtually indestructible. So it doesn't get impaired, unlike all financial assets, where you can have a default or you can have cancellation of obligations, or you can have the system going down. There's nothing to go down. Each piece of gold exists independently from the world and is indestructible. And the third factor that does not pertain to most assets, it is genuinely scarce. There's only one kind. There are no multiple kinds, can never be any other kinds, has never been any other kinds of gold. And so it is genuinely scarce. And like lifeboats on a sinking boat, on a sinking ship, the value to the passengers of a lifeboat changes exponentially and dramatically, or can change exponentially and dramatically in a split second, from having no interest in having lifeboats to having no interest in other than lifeboats, because the circumstances have changed. So in that sense, let me give you an example from what's going on in the market, gold market, in the last 18 months. So the traditional correlation between real rates and gold price has broken down. In, say, last year, rates went up and gold went up. That's unusual, because for the past 30 years, or 30, 40 years, period of financialization, disinflation, globalization, gold price, supply demand was pretty much driven not by safety considerations, some safety considerations, but mostly by financial considerations. Of course, there are savers in Asia, but that is pretty stable. So the marginal spikes and ebbs and flows of demand for gold, which is what sets the price. Since there's no cash flow, it's basically supply and demand. So what regulates marginal, I should say, supply and demand? So marginal supply and demand in a significant way is driven by changes of circumstances, and has been primarily driven by Western speculation or accumulation for financial reasons, as opposed to lifeboat reasons, if you will. And so what we saw in the last 18 months, and that also ties into geopolitics, the high watermark for gold accumulation by the ETFs was in February of 2022, which is the Ukrainian war started. By October of 2022, and I'm not saying that this is causation. Maybe these are coincident things that happen at the same time. But looking at the numbers and looking at the graphs, that's what it is. So let's for a minute pretend, posit that there may be a connection. By September, it seemed like Russia was on the back foot. Maybe the danger has passed. ETFs started shedding gold. The price of gold started going down. There has been tremendous correlation up to that point between the price of gold and the amount of money flowing in and out of ETFs, or the amount of tonnage that these ETFs held. Now, as I always say, they taught me in business school that you're supposed to buy low and sell high. But if you look at the chart of flows in and out of ETFs and gold price, it's usually when the price is going up, people are buying these ETFs, and when the price is going down, people are selling these ETFs. So you sell, it's in the opposite direction. But what happened in October, or what has happened since October of 2022, is that ETFs have continued to shed inventory, whereas the price of gold has been going up. So through today, the price of gold from there is up 25%, and the ETF inventory is down 11%. If you look at from inception of ETFs in 2004, we have not seen that kind of parting of the company. And so I wasn't totally sure, just logically, that would suggest that something else is driving the price of gold other than ETF flows or Western investor interest. But yesterday I had an opportunity to speak to two people from two of the largest secure logistics companies, that vault gold and transport gold around the world. And they both, independently of each other, told me the same thing, that for the past number of months, there's been a very strong flow of gold from the United States to Asia. That premiums in China are so high. We're all looking at the same chart of price, but the difference in price in the physical market is called premium. So there could be, a $2 premium over what you see on the screen, but it could be $100 premium, what you see in the screen. Now, in plain language, that means that gold, if you actually want possession, it's $100 higher than what you see on the screen. That's the meaning of the premium. And so that the premiums in Asia have been so high that it's been financially feasible for speculators to take physical bars, put them on the planes, ship them to Dubai, ship them to China, to Hong Kong, recast them there into local formats and sell them in that market. So in the framework that I just shared with you, I would say that Western investors are selling their lifeboats because they don't see the volatility. And so they see profit in shipping their safety equipment offshore, unfortunately, never to return, I believe, or at least not to return in any foreseeable future. Okay, so now that I've explained how I think about it, we can talk about the weather, which I'd say the conditions, which way the wind is blowing, which way the current is going, and which course we're traveling upon. So that's my little introduction, if you don't mind.
Absolutely fantastic. Ralph, I'll let you take it from here.
One question that might be interesting for listeners, because at the end of your introduction, you spoke a little bit also about geopolitical issues of gold. So just a few hours back, or not even a day back, Ursula von der Leyen, the president of the European Commission, has once again floated this idea that profits from Russian assets in Europe, particularly in Belgium, it's around 200 billion euros, that they should be used to rebuild Ukraine, that they should be funneled to Ukraine. The Belgians are still resisting. They say, this is a problem potentially for the role of the euro as a reserve currency. There are legal issues, but the tendency alone, do you think, as you mentioned it, I think the description for gold as a lifeboat is a very good one, but not just for investors, in many ways also for states, that there is a tendency then of states in Asia and elsewhere to say we can no longer, on the long run, fully trust the dollar-denominated international system, and wherever possible, we switch to gold. Or, for example, that energy maybe at some point is closer tied to gold and no longer as close to the dollar. Do you think on the long run, I mean, this is not something that's going to happen tomorrow or the day after tomorrow, but do you think that on the long run, this is a possibility and that gold will find a new and even more important role than it did in the past?
Look, nobody knows the future. Central banks use it as a lifeboat too. I mean, it's the only financial asset that doesn't have counterparty. So if fiat currencies fail or for whatever reasons become inaccessible because of the geopolitical breakdown of the financial system or geopolitically driven breakdown of the financial system, then obviously you have to go to something that works. And so gold is that vessel, if you will, or is that lifeboat. No, you're absolutely right. I mean, this invites really the discussion of the whole pivot in geopolitics over the last 24, 36 months. I mean, it's been long coming, but it erupted into an acute phase, if you will, in the last 24 months, with the Ukrainian war. But basically, the response of the West, collective West, if you will, to that event was to make very high bets that so far have not only not paid off, but in fact, spectacularly backfired. I mean, in the world of geopolitics, it's a little bit like, jungle. I mean, the alpha predator or the hegemon cannot get out there and say, all the things that we said and not deliver on them. Like we said, that we're going to crush the Russian currency. We're going to pass the sanctions, adopt the sanctions that would destroy the Russian economy, that we are going to strive for implementing regime change in Russia, and that we're going to defeat Russia, make mincemeat of them in the battlefield. Okay, well, it's 24 months. None of this happened. And furthermore, as you just brought up, we staked the reputation of the West on which the entire Western financial hegemony has been based, which is the preeminence of the dollar as the reserve currency and legal guarantees of the property rights. That regardless of the politics or regardless of whatever we like or we don't like, that the Western financial system is operated based on property rights and the rule of law that is enshrined and guaranteed and is inviolable. Because you can't have your banker be your political opponent if he's just going to take your money when he doesn't like your politics. I mean, that's not how it works. So by essentially imposing the sanctions, freezing this money, we have sent an extremely strong message to people who disagree with the Western politics and policies and geopolitical positioning that your money is not safe with us. I mean, that's common sense. I mean, that's not an opinion, that's an observation. And clearly, this is having consequences. There will be consequences, and there are consequences. I wouldn't call it, as you said, not today. Well, it's not a run on the bank, but it's already a walk on the bank. I mean, it's clear that strategically, BRICS countries, which is essentially a bloc that has arisen and is uniting in opposition to the Western alliance, in economic and geopolitical and now military and financial sense, is contemplating alternatives. And when we say that, and the reason I gave this analogy with the Titanic is because it's apt, because the volatility, the sailing was very smooth up until the moment the disaster struck. I mean, there was no sign in advance that something was wrong. It wasn't like they hit a storm and the storm went on for days and they couldn't make it. No, it literally happened in minutes. And so the danger of the situation that we're in, and a political situation we're in, for example, 2 days ago, President Macron suddenly said, well, maybe we need to consider putting troops in Ukraine, NATO troops in Ukraine. Well, Russia has made it clear that that would be an act of war and that would embroil NATO in a direct confrontation with Russia. I mean, is that what we want? Well, it seems like we're traveling along that path. So and that type of a situation, all ideas about how financial system works and the demand for dollars and the debts that need to be satisfied in dollars, that may all go out the window in a moment. Because people who owe in dollars suddenly declare that they don't owe anything in dollars to anybody on the Western side, and the game's changed. It is also possible under circumstances like this that Western governments, like they've done in the Plaza Accords and like they've done in Bretton Woods, suddenly or like Nixon did in, on a Sunday when he took the dollar off the gold standard, will get together. And they don't need to physically get together these days. And they can make a decision that they need to change the game because they're at a significant peril. And so I think that this is an extremely dangerous situation because the volatility is not apparent. And if we move to the political situation and the economic situation, and the monetary situation, which is what we're discussing now in connection with geopolitics, it's like, the third-class passengers are getting nauseous, the second-class passengers are getting apprehensive, and the first-class passengers are the roulette tables loading up on caviar and champagne, thinking everything's great. I hear Titanic has the most fabulous first class ever designed, with Turkish baths and everything. I mean, sounds like today's billionaires with private jets. I mean, it's so... I know I keep using this analogy, but there is really an analogy. I mean, there are analogies in history, as you know, and there are many very difficult analogies. I grew up in the Soviet Union. I left, fortunately, my family left 13 years before it collapsed, but I've watched it very closely. And the period of what is now called the period of stagnation, which in retrospect, now we can say was really the period of decline leading up to what happened. At that time, everybody thought everything was static, zero volatility, nothing changed until, it was forever, until it was no more. There's a book under that name, literally overnight. Nobody saw it coming. And so, and the reason they didn't see it coming, because it's been so long in coming that by the time it came, everybody had given up. They said, well, yeah, it doesn't make any sense. like our chairman of the Federal Reserve says, we're on a sustainable financial path. Yeah, well, we have been for 40 years. Maybe it'll be for another 40 years, right? That's the thinking. But unsustainable means cannot be sustained. So at what point does it end? It could be next Thursday. It could be Thursday 5 years from now. We just don't know. And so I think that the mentality of investors is that the ship is unsinkable. And so pop more champagne.
So
Sorry, go ahead.
Go ahead.
No, just one quick one. I'm sometimes reminded, I think it was, I don't know the precise year, was it in 1932 or 1933 under Franklin Delano Roosevelt, when basically the government forced people to give up their gold and hand it over. And what you just mentioned earlier in your introduction is this selling of gold for a premium in Asia could hypothetically, and would it be in their interest? Could the US government, could European governments, could they do the same? Could they simply outlaw the free trade of gold of individuals and make it a purely state asset?
They could, but if you take that example, now of course history doesn't repeat exactly, but if you take that example, that happened 4 years into the Great Depression. I looked it up. That year, S&P 500 hit the low of 7. Okay? 7. So they didn't confiscate gold. They forced everybody to sell it to the government at $21.70 an ounce. Had you taken that $21.70 an ounce and put it in S&P 500 at the value of 7, I think that would have been a very good move in retrospect. Okay? So usually that happens after disaster struck, when everything else looks completely dire. And then maybe it is time to relocate from gold into other tangible assets at a price where gold's purchased. So gold's purchasing power, I mean, think about it. Gold's purchasing power, 1 ounce of gold bought 3 units of S&P at that time. Yeah. By the way, I mean, it's not that far from it now. But of course, from that floor to where it went, I mean, that would have been a very good move. That's one thing. The other thing is, at the time, we have to remember that gold was money. Gold, it was officially, dollar was supposedly exchangeable into gold. And so the government wanted people to take basically money from people. I mean, that's what it was. Now, today, the entire asset management complex in ETFs is $200 billion. Today, I looked it up. It's nothing. I mean, high yield market is $1.5 trillion. Stock market is 50 trillion. I mean, it's a peanut. Last year, the sale of coins by the U.S. Mint was less than $3 billion worth, and that was down 20% from the year before. So it's not a factor. Like, they may do something like that, but it's not a factor. It is more likely that they would do capital controls and prevent people from moving money offshore. That would be more meaningful than forbidding gold. That maybe in Germany people have gold, in Austria people have gold. In the United States, nobody has gold. I mean, when I say nobody, I don't mean in a meaningful way, And how do you enforce something like this? Like, that's not crypto. You can't, there's no AI and there's no big data. What are you going to send agents rummaging through attics and basements looking for coins? There's some complicated obstacles to that. So anyway, that's my answer to your question.
Thank you.
What are the systemic risks to the scenario that you're presenting, where we have the West substantially not caring, right, about their lifeboats, and we have Asia buying a lot of gold? So what are the systemic risks to our system, being that this is the case right now?
The systemic risk is impoverishment of the U.S. population. That's the systemic risk. And if you tie that to, we just saw the Middle Eastern, the war in the Middle East unleash a tremendous spike in anti-Semitism from the left, which, Ralph, I think you tweeted about. Um, I grew up in a system where I had to learn all about Marxism-Leninism, a lot more than I wished to do, but I had to. Marxism-Leninism is, it's a complicated discussion, but the simplest way, so the bright red line that goes through that, the theme that goes through all those ideologies is that the world is divided into oppressors and oppressed, that oppressors are always wrong, the oppressed are always right, and the oppressors are always wrong, that the rights of the oppressed always come ahead, legal rights, property rights, all rights, freedom of speech rights of the oppressed come ahead of the oppressors, that violence is justified. And we're seeing in American colleges, a real rise of this ideology. There are different groups of oppressors and oppressed. And so when you're saying, what are the systemic risks? So, imagine what happens in a financial crisis, which our Fed chairman says is inevitable, because if this path is unsustainable and there's no evidence that we're changing the path, then it's just a question of when. It's not the question of if. The math has to work. Everybody says, well, 30 trillion, maybe we're going to have 40 trillion, 50 trillion, 60 trillion. The numbers don't matter. This is a game of confidence. It's all about confidence. Zimbabwe didn't have a lot of confidence. The United States has a lot of confidence, but we've been cashing in our confidence for the past 40 years. We've been trading on, credit is about belief, credere, Latin word credere, belief. So confidence and belief are not linear. It's emotions. Emotions don't operate in a linear fashion. You have a belief until a few people lose, and then a few more, and then a few more, and then there comes a point where confidence is lost. At which point, if the system is sound, confidence can be restored. But if the system is unsound, you cannot restore confidence. And once you lose it, then you have to take repressive measures to contain the situation. So the reason I'm mentioning this rise from the left of this new strain of anti-Semitism, which to me is a symptom, which is what I experienced growing up in the Soviet Union, very similar. It's not the same as the right anti-Semitism. It's a very systematic, anti-Semitism with the media and the universities and the intellectual, basically complex behind it. These ideas, when they become nascent and present in the society, particularly among the young people, when you have a financial or economic disaster, this is when they rise to the surface. And so when you have these types of ingredients embedded into a mix, and we know that body politic in the United States is divided dramatically. So we have a house divided against itself. And we have these types of ideas that are percolating and have just been demonstrated in a very apparent way. Now, most people don't recognize it as such, but people who are not terrified by this should read up on history. There's a lot of history, and I can't prove it to anybody, but I can tell you, I spent 20 years in the Soviet Union. The failure of socialism and communism in the Soviet Union was not due to bad execution. It doesn't work. These ideas don't work, and the system doesn't work for all kinds of human basic reasons. And so when I see something like this, and of course, all this is connected to property rights. This isn't a political discussion. When Marx, Lenin, who owns what? It's not the oppressors who are supposed to end up with anything. So investors should pay a lot of attention to these seemingly completely political and unrelated phenomena that are developing inside Western societies. So yes, I think it's extremely dangerous. So yes, there is systemic risk on multiple fronts: financial, monetary, geopolitical. And again, Ralph, you probably know more about it, but even just looking at our industry, and like production of shells, 150 millimeter howitzer shells. Here's the Russian economy that's supposed to have been nothing, that we would just blow and they would fall. and they're producing 7 times more shells than the entire Western industrial system. And this is before China gets involved, which is the largest industrial base in the world. So, hubris, Titanic sank with so many people dead because of hubris, because of a complete miscalculation of what the risks were, and a complete unpreparedness for what to do if disaster struck. So I think, unfortunately, the parallels are a little too close for comfort.
Help you to go.
Yeah, I mean, this is fascinating. I never looked at this, all these different things being tied together, and I think this is absolutely fascinating and really interesting. Now, when you continue, because I always find this kind of a great way to illuminate what's going on, this dive in history. Do you think it was at the end of the day a mistake to give up the gold standard? This idea that a currency should be at some point tied to something that's real, that physically exists, and not just on as it was in the case of the United States, as long as you said before, as long as it worked, right? The world's major superpower, the world's major economic power, the world's major military power. So all these structural elements underpinned the currency. But now, of course, as the United States, if you look at debt levels and as if you look at certain elements in the demographic developments, of course, that structure, I think it still looks better than the rest of the world in many areas, but it's weakening. I mean, Tracy and I think we've been in a million Twitter spaces. And so, well, we took a very, let's say, dollar bullish side, but I have to admit, in recent weeks, I mean, I'm still, let's say, I'm not bullish anymore. I'm still confident, but it's weakening. I'm wondering myself, maybe if I've been too confident in the power of the dollar as a single element and the broader, let's say, Western designed financial system.
Look, again, we are, many people throw out this cliche, we're in uncharted waters, okay? And when they say that, they don't, people say things and they don't think through to what they just said and what it means. Again, as a sailor, I can tell you, if you happen into uncharted waters, you have no idea what's going on. You don't know where you are. You don't know what's ahead of you. You don't know what's around you. You don't have a chart. So when you're in uncharted waters, to then say the financial system, I had a conversation on Twitter about it yesterday, that to say then, well, the system works this way, therefore, if this happens, this will happen. No, because the whole idea here is we have a systemic problem. The going off the gold standard was caused by the inability of the capitalist system to deliver growth without relying on continuously growing the debt. We have been in a situation for 40 years where the West has been unable to grow economically without continuously expanding the credit. Okay, so this is a credit-driven economic model. Just through sheer gravity and the force of numbers, it is not endless. The meaning of the gold standard, without any ideology whatsoever, it's simply a restriction on the amount of money. It's a limit to how much money is how much capital, real capital, is available or should be available. And therefore, it regulates the value of capital. And the value of capital in the capitalist system, which is the interest rate, is the most important fundamental signal to the participants in free market in order to allocate capital to the most financially promising and productive endeavors, as opposed to building pyramids, So by perverting the interest rates, by controlling the cost of money, we have no, I mean, when people say we are out of bounds, they don't even know how out of bounds we really are. We are so out of bounds that it's scary. Now, I'm not saying it to panic anybody. We have to be realistic. We have to have, there has to be some sense of reality as to where we are in order to set the course that will get us to where we're going. Because if you don't admit the problem, you can't, there's no way to start working on a solution. So what I mean by this is that the entire financial system, every valuation of every financial asset is based on the capital asset pricing model. It's a present value of future cash flows. This is all these multiples in the market, everything, X times cash flow. This is all boils down to the capital asset pricing model. And the capital asset pricing model is based on the risk-free interest rate and the risk premium above that rate to evaluate the projects. If those inputs are perverted, controlled, or incorrect, everything is mispriced. Absolutely everything is mispriced because you don't have the right input into the model. You're using an assumption that is a faked or controlled assumption. And if a situation arises where the system breaks down and the true cost of capital comes to the fore, you have no idea where you end up. And of course, because leverage is built on these valuations and these assumptions. So this is very concerning. This is how I got interested in gold in the first place. It's after the first, after the 08, when I understood how, when instead of, re-upping the system, essentially restructuring it to put it on a solid footing, we essentially bailed out a bankrupt system and allowed it to re-leverage and continue to grow the leverage at a rate that we haven't even seen in history before. I understood that this is a trip without a good destination, that it's a matter of when, but not if. And I have to say that this political situation, that's very concerning. But in terms of life, and of course, it's also very concerning in terms of nuclear threat. But in terms of financial debacle, Soviet Union collapsed. People lost everything. Lives were destroyed, but Russia didn't slip under the waves. Austro-Hungarian Empire disappeared, but Vienna is a beautiful city with a wonderful food and great culture, as is Budapest. British Empire is no more, but UK has not gone, and neither has Netherlands or the Spanish Empire or the Portuguese Empire or the Ottoman Empire. Okay, so the loss by the US of hegemony is a very dangerous passage because of these political problems that I just mentioned in terms of potential societal issues. But it's not the same as Armageddon. I mean, people think that they don't need to worry about their money because if Lehman Brothers fails, what do we need to worry about? We have bigger problems. No. Lehman Brothers failed, but everybody else didn't slip under the waves. And yes, and if you were a counterparty to Lehman Brothers, you got a problem, but the world didn't end. Okay, and now you have to live without the money and go back to your family and say, well, I didn't think about it. Now we're going to have to work in a different way for a living. So I'm just saying that it's extremely important for people because people tune out when they think this is doomsaying, and this will never happen. And if it'll happen, it's not going to be anything to do with me. I mean, I grew up with grandparents who were born before World War I in Ukraine, who lived through World War I and the Civil War and the Stalinist purges and the siege of Leningrad. And then my grandmothers came with us to the United States and lived here for 17 years. So you know what? No, you're not going to die. You're going to have to deal with the consequences of not preparing yourself for what may happen. So it's a very relevant discussion, and it's not doomsaying. It's really just trying to manage the risk. I mean, that's what insurance industry does. That every company has risk managers that do that. In finance, for some reason, risk management is limited to buying hedges, which are essentially backup generators plugged into the same grid. I mean, if the market goes down, where are your hedges? No. By the way, that's the only field of human endeavor where backup systems are tied to the primary system. I mean, in aircraft, nobody would have a second engine running off of the first engine. I mean, that just doesn't happen. But in financial system, sure, you buy an option at an exchange on a stock, and if system goes down, there are no options and no stocks. So there you go.
So how long do you think the Federal Reserve can kind of keep this going? I mean, even Powell has basically said, our fiscal situation is in trouble, right? But that's not his job. So, how long do we extend and pretend? How long does this last? I'm not trying to put you on the spot and give you to have you give us an exact timeline, but it seems like we're pushing the depths of the extend and pretend. And even, they're talking about how we know regional banks are going to start failing, and we're going to prepare for that, and we're going to consolidate. And it's going to be 2008 again, where you have regional banks fail, they get sucked up by the larger banks that are backstopped by the Fed, and then the balloon just gets larger and larger. And so, to me, there seems like there's a lot of danger involved in that people are not correctly not correctly understanding. And I think and then this is kind of a two-part question. And then there are the other people that say, well, the euro dollar market is the offshore dollars in euro banks, not the euro, is so big that the dollar possibly cannot fail. So if you could maybe talk about those two things. I know they're kind of different, but they are kind of related.
Look, again, not to get deeper into doom, we're living in a very, very precarious moment in human history, okay? For 500 years, since the age of discovery, 1400s, the Western Europe, and then the United States have enjoyed absolute technological, financial superiority and military superiority over the rest of the world. I mean, it's a fact. Well, because of our policies, and this is not by accident, this was done, we did it to ourselves. If you go to YouTube and you Google, there's a great interview from 1993, I think, of James Goldsmith with Charlie Rose. It was in connection with the book that Goldsmith wrote called The Trap, where he, prophetically predicted what was going to happen with the World Trade Organization and sending manufacturing to China and industrial agriculture and the immigration crisis and the impoverishment of the Western civilization and all those trends. This is 30 years ago. This is 1993. So all these trends have been long coming. So to answer your question directly, nobody knows the timeline. The problem is it's a multifaceted thing. We're coming to an end of it's difficult to intellectualize it and feel it in real sense. But like Russia faced it with the Russian Revolution. It was a complete revolution, like turnover, full switch. The Romanov dynasty ruled for 300 years. The Russian state at that point was 800 years old or whatever, 900 years old. Everything was a certain way. And then it just went completely pear-shaped, upside down, in a way that nobody could possibly anticipate. And how it was brought on? It was brought on by war, by an economic crisis, by hyperinflation in Russia, and a tiny minority, Bolsheviks, the ultra-left wing of the social democratic movement, supported by many wealthy people, by the way, in Russia, and nurtured by them, liberal people, took power, and it was a disaster. So what I'm saying is that we are at an end of a very long period where there's a tremendous global rebalancing of power and influence and financial might. And how this process proceeds is impossible to predict. It's also impossible to predict the speed. We don't have the models. We don't have there's not even, it's like history and common sense suggests that things that are not sustainable will not be sustained. But looking at the euro dollar market or this market or that market, it's very easy to get bogged down in statistics in the weeds and looking at the inflation statistics month to month, when in the meantime, the world is changing in front of our eyes. And Ralph is sitting more in the middle of it and maybe feels it more than people in the US do, because geopolitically, US, and Americans are used to, having an ally on the north and a friendly country in the south and two oceans on both sides. And it's kind of not relevant or not immediately relevant. There hasn't been a war here since the Civil War, and nobody remembers that. So it feels very differently in Europe, but we're in a different world. We're not even in the World War 1930s kind of world, because the impact of financial interconnectedness, the internet interconnectedness, the weapon system. Nazi Germany could not bomb the United States. Okay, well, that's not the case here. I mean, we have ballistic missiles, and we also have now, Russia has nuclear powered ballistic missiles that can stay afloat indefinitely and fly around the world into space and back, and God knows what. I mean, we're really operating in a very different environment. So my point is not to scare anybody. My point is not, there's only so much anybody can do to prepare, but my point is to awake people to the reality that we have systemic risk, which is existential. And we can't do more than we can do. We should live our life day to day and enjoy our children, and we shouldn't go into bunkers. But you have to prepare. You have to make, like in sailing, no captain ever thinks of safety gear as dead money. But in finance, they think of safety gear as dead money because it's not producing immediate return to you necessarily. So, lifeboat, okay, well, it hasn't given me much return lately, so I will sell it to another guy. I don't need a lifeboat. I can profit from it and put it in the market. That's the mentality, I think, that is increasing risk from very high to existential, because you can survive financially, you can even profit from crisis. There's always, opportunities in crises. In fact, more opportunities than sometimes without crisis, because nobody has liquidity if you're the only one with liquidity, but you have to have the right vessel. You have to have the right crew. You have to have the right course, and you have to understand the conditions and recognize the conditions for what they are. And I don't think that people are attuned to that because there's no experience. And so they have confidence in systems, things, and frameworks which may not deliver in a way that we think they would. And so I think that's why I think geopolitics is critical, because this geopolitical confrontation is about the money as much as it's about anything else. It is because when those who live by the sword, die by the sword. Well, unfortunately, we have staked a lot of our preeminence globally on finance and the dollar role. Okay. And when we expose it this way, and then we don't have strong financial position. So when you tie your fortune to finance, and then you yourself do not have a strong financial position, that potentially is a problem. That's like leverage. That's like going out on the limb with a lot of leverage. That's basically where we are in financial sense. We have huge leverage with no volatility, and a lot of people specifically looking to create volatility. Okay. And these are very aggressive and very competent people who can strike who will strike probably at the moment of highest vulnerability for their purposes, should they want to. So you should never give the keys to your kingdom to somebody else. And I think we have done that by doing what we're doing with potentially confiscating Russian assets, by making dollar property rights pertaining to the dollar tied to the political leanings of the owners of the dollar, and so on and so forth. So I think it's time to just take all this in and do proper things. Like, think about how to protect yourself, not about everything's great, send in more champagne and caviar, and let's go to the roulette table because the sea is smooth and we're having a great time. That's because there are icebergs in them dark waters. So
Absolutely, absolutely makes sense. I want to give you the opportunity if you had any final closing comments, Simon. The hour has gone by so quickly. But really, as investors, because there's a lot of investors that are going to be listening to this, what should we really be focused on over, the next couple years or so? In terms of, how we want to position ourselves?
I think people should consider the vulnerability of financial assets in general because of the interest rate suppression, because of the levels of leverage that are embedded in the system, not just obvious leverage, but the shadow banking system and the derivative complex. And essentially what you said, Tracy, is that the governments have essentially taken the ultimate risk onto themselves. So if they have underwritten the entire financial system, that it boils down to the credit worthiness and confidence in governments. And this is where this geopolitical conflict has direct impact, because it is a battle of giants, and little people get trampled in the battle of giants, and so I don't mean to diminish anybody to diminish anybody by saying they're little people, but what I'm saying is this is a very big fight that's going on between the East and the West. It doesn't matter for us at this moment who wins, but the volatility that may arise in connection with settling of these issues can be worse than nauseating. So I think that people need to consider how they're positioned in terms of their financial assets, in terms of their obligations and leverage, in terms of what real assets they have. And I'm not suggesting physical gold because this is what I do. I do it because this is the conclusion that I came to. I've been a financial investor for 30 of the 40 years that I've been doing this. And so I've come to the conclusion that this is an appropriate lifeboat. It's not the way to get rich. It's a way to stay that way if you're already there, or if you already have assets to lose. And so I think people should consider very much the options and the real assets, and how to sequester some purchasing power outside of financial markets should this disaster be visited upon us. And I think it's a matter of time because of all the things, again, not a prediction, it's an observation. Because of all the things that we know exist, I wouldn't dismiss them because everybody thinks it's okay, because it's been okay. Well, it's been okay, but it may not always be okay. So that's my parting thought.
Thank you very much. And if people want to get a hold of you, how can they get a hold of you, Simon?
They can look me up on Twitter, S_Mikhailovich, or they can look at the TBR website, bullionreserve.com. Very simple. And whatever. I'm fairly easy to reach.
Exactly. And we'll put all of that contact information in the details below. Thank you so much, Simon, for your time today. We really appreciate it. I've been wanting to do this interview for a while, and so it's great to touch base with you and have you share your insights.
Thank you for having me.
Thank you.